Good afternoon and welcome to the Equifax Market Pulse webinar, where we're going to be talking you through the Q2 2025 consumer credit trends and economic insights. My name's Becky Oakes. I'm the Vice President of Analytics here at Equifax Canada, and I'm joined today by Kathy Katsileris, our Vice President of Consulting, and Swanama Pandey, who is our Head of Insights. Now, before we get started, I'm just going to hand over to Jordan, who's going to talk to you a bit about the On24 platform and how things are working. So, Jordan.
Thank you so much, Becky, and good afternoon, everybody. Thank you all for being here with us today, and I'm here to provide you with a brief overview of the platform that you see in front of you. So each area within the On24 webinar platform is responsive so that you can maximize or minimize each widget or box on your screen based on your viewing needs. There is an Ask a Question widget underneath the media player, so feel free to enter any questions you may have, and that we'll try to address them throughout the session today. In the event that there are too many questions to get through, we will reach out to you individually to follow up in the coming weeks. Today's presentation in English and French is available for download in the related content area, along with a lot of other great material. The session is being recorded, and you'll receive the on-demand link via email tomorrow. Now, there's also a couple little boxes on your screen where you can register for our upcoming Q2 Market Pulse Business Trends webinar. We'll be looking at the Canadian small business health challenges and opportunities. Sinead Gleason, Jeff Brown will be leading that session with a special guest from Nielsen IQ. The second box is to register for our Market Pulse Fraud Trends event on October 2nd, where Cheryl Prince will be highlighting fraud data across the auto, banking, telco, and mortgage industries, and much, much more. Some additional features you'll notice on the bottom of your screen are reactions, so that you can let us know how we're doing. The thumbs up, the hearts, the laughs, the cries, whatever. Our contact us and our survey. You can fill that out during or after the session. Feel free to check any of these out, provide your feedback. Even if you've done it before, we really appreciate fresh comments. And with that, let's get it started. Becky, back to you.
Thank you so much, Jordan. And hopefully there will be no cries coming through on those emoticons. So just as we get started, of course, we normally like to talk a little bit about what's happening in the economy here in Canada, because this has really been a period of quite uncertain times. So hopefully we can talk you through some of the things you probably should be thinking about right now. So first of all, let's start by taking a quick look at the GDP numbers. Now, unfortunately, in the second quarter, we did see a bit of a noticeable decline in both overall GDP and also in GDP per capita. Now, that's probably not too much of a surprise, as we know there are still a lot of challenges in terms of the trading conditions across Canada. And one of the big contributors to that decline is linked to kind of a bit of a sharp decline in terms of exports of goods, especially across some of those key sectors, such as industrial equipment and motor vehicles. So that's one of the reasons why we're seeing that GDP drop a little bit. There is some good news, though, in that the domestic demand is quite strong right now. We're seeing government and consumer spending helping to prevent more significant downturn across the country. Now, that doesn't mean that there isn't some pullback in terms of spend across some of those consumer segments, and we'll touch on that a little bit later on. So that's GDP. If we move on to what's happening on the inflation side of things. Now, unfortunately, the August inflation numbers aren't due to be released until Thursday. But if we look back in terms of what we saw in July, we did see inflation remaining fairly low at 1.7%. Now, the challenge really is that fall in inflation is really linked to gasoline prices year on year. Now, those gasoline prices did benefit from the removal of the federal consumer carbon tax in April. So that's really helped bring those prices down. But the challenge for many consumers across Canada remains that a lot of those essential items like food and housing are still rising at a rate well above 2%. You know, if we look back towards kind of the first period of the pandemic compared to now, consumers are paying around 25% more for groceries than they were back then. So cost of living is still a bit of a challenge for certain groups of consumers. And when we talk about credit performance, of course, your cost of living does contribute to what we see in terms of some of the payment behaviors and elements across credit usage. The other macro measure, which is really important to be monitoring when we look at the credit industry, is what's happening in the labor markets. Now, in relation to credit behavior, a rise in unemployment is really what we call a shock factor. When we see that unemployment going up, we often see a deterioration in terms of some of the credit measures that we look at, things like payment behaviors, quite quickly afterwards. Because, of course, if you don't have a job, it can be very difficult to keep making all of those payments on your credit commitments. Now, unfortunately, the latest numbers from Statistics Canada do suggest that overall employment levels fell in August with a drop of around 66,000. Now, if we dig a little bit deeper and look at where that's happening in some of those key business industries, those losses were really evident in areas such as transportation and manufacturing. And of course, we know that they really have been impacted by some of the trade-related uncertainty that we've had in recent months. We also do see this when we look geographically as well. So areas like Ontario, Alberta, and British Columbia, they're seeing some of the largest declines in employment levels. Now, Ontario, of course, they are impacted in sectors such as the auto industry. In Alberta, we have the energy sector, which is impacted by some of the trade conditions. In BC, we know there's been some challenges around lumber sales and exports to other countries. And of course, steel industry impacts several as well. So there are a lot of understandable reasons why we might be seeing those employment levels declining in some of those geographies. Now, we are, of course, hoping for the rest of the year that some of the federal support measures that have been announced recently, for example, last week, I think the government announced $5 billion in investments through a new strategic response fund. We're hoping they might starve off some of the potential impacts that we could see later on in the year if things continued the way they are doing today. So that's the employment side. Unemployment also did rise in August. Interestingly, for this period, we actually saw that unemployment level rising a little bit faster for the core employment ages. So by that, we're talking 25 to 54-year-olds. Now, in the recent quarters, if you've joined us before, you'll know we've been talking more around unemployment levels rising for younger consumers. And for that group, it is still high year on year. But the shift that we've seen in the last quarter is really those middle age ranges. And that really kind of links back to some of what we're seeing in terms of the business side. And again, some of that uncertainty in the economy that's kind of driving some of that. Population-wise, immigration levels do continue to slow down. So when we look at population across Canada, although it is up, it's certainly come down from some of the peaks we saw in recent years, which you can see on that left-hand side. Now, in particular, Ontario and British Columbia have actually seen populations declining in terms of the volumes. Now, some of that is actually linked to interprovincial migration. So we are seeing consumers trying to really balance this ongoing challenge with high cost of living, high rental prices or house prices in some of those regions in particular, and they've been leaving the province to go to areas that perhaps are a little bit more affordable. So Alberta is the main one that's seen a lot of that pickup in population growth, and we'll talk a little bit more around some of what that's really meaning for Alberta on the credit side as well. And then finally, just to touch on international trade. So the left chart that you see here, you'll see there's two lines on there, orange, which is imports into the country, and the blue line is exports. And this clearly starts to show you some of the challenges that really we're seeing from a trade standpoint as a result of some of the difficulties that we have right now with some of our trading partners. Now, at the start of the year, we actually saw a bit of a bump on exports as many businesses tried to really get ahead of some of those, potential risks on tariffs. But that doesn't really cover the extent of the drop in exports that we've seen the last few months. You can see that blue line really dipping down. The trade deficit has actually widened to close to $6 billion in June. Now, a little bit of good news, I guess, is we are starting to see, though, some signs of adaptation in the market. And perhaps, longer term, that need to diversify really our exports and kind of where those exports go could actually be more of a positive shift for Canada longer term. But of course, there's that short-term pain we have to go through. So, for example, in Quebec, when we look at things like aluminium exports to the US, they actually fell from around 95% of what they produced to 78%. And a much greater percentage has now started being exported to Europe. So we are seeing that kind of diversification coming through, which, again, longer term might bode a little bit better for the economy. So that's kind of very super high level what's happening economy-wise, but what does this mean, of course, for the credit industry? So as we start to kind of shift and look what happened in Q2, I have a little bit of good news finally, which is delinquency-wise, when we look at missed payment levels, we're finally starting to see some signs of stabilization. Now, that doesn't mean they're coming down particularly yet, but they're certainly flattening off in many of the sectors. So that's the good news. The less good news, unfortunately, though, is that we do continue to see a widening in terms of the financial gap when we look across different groups of consumers. Now, this is really important because, as you start to evaluate potential areas of both risk or growth in your portfolio, understanding where those areas of risk and growth are is really important. And, when we start to look at some of the key groups that's highlighted on the slide here, we're seeing things like homeowners versus non-homeowners, and kind of the separation around some of those missed payments, that's kind of widening, and I'll show you a few slides in a minute on that. But also in some of the geographies like Ontario and Alberta, we're seeing demographically, again, some of those younger consumers see more financial stress coming in. So some good news in terms of the overall levels are leveling off in terms of missed payments, but less good news for some of those particular groups that we need to focus on. So taking a bit of a step back, overall debt levels across Canada in Q2, we reached $2.58 trillion. That was up a little bit over 3% year on year. Now, the growth in debt has actually slowed the last few quarters. So it is up year on year, but it's starting to slow down. And that's a little bit to do with population growth slowing down. So some of the new, the volumes that we were seeing before in terms of new people entering the country, getting products like credit cards and starting to kind of increase the balances on those types of products, that's slowed down a little bit. We also believe this is actually to do with consumers pulling back a little bit in terms of credit usage, especially for homeowners, and we'll talk to you a little bit about where we're seeing that. But, across the board, it is still up. Seasonally, though, across most products, we're seeing slower growth than we typically would expect. So in the second quarter, we do see balances rise normally across some products, but it's a little bit slower than we typically would expect. And on that right-hand side chart, you'll see that this is just kind of the difference between consumers who have a mortgage and who don't have a mortgage, and what's happening in terms of their change in non-mortgage debt. And this is where we're seeing those non-homeowners, the people without a mortgage, we're still seeing their debt levels rising, whereas those homeowners, they're pulling back that little bit more. In terms of missed payments, so as I mentioned, delinquency levels starting to kind of level off a little bit, which you'll maybe start to see on that right-hand side chart. However, when we look at a product level view, those missed payment levels are still higher than they were 12 months ago on mortgages, on loans, on credit cards, on unsecured lines of debt. So they kind of are higher. Around 1.4 million consumers still did miss a payment in the second quarter. So we're not completely out of the woods, just because there is some signs of a little bit of a kind of flattening on those missed payment levels. That right-hand chart, this is where it's a great example of some of that financial gap that I was talking about earlier. So that chart on the right shows the percentage of consumers who miss at least one credit payment somewhere. So it could be on any of their credit commitments. And you'll see that blue line is consumers who don't have a mortgage. The orange line is consumers who do. Now, when we go back a few years, the kind of difference between those two lines, we kind of saw that the non-mortgage holders, their missed payment levels were around 50% higher than those that had a mortgage. It's now double. So, there is that widening, that kind of gap is bigger than it once was. And again, that kind of just starts to kind of show that although overall we might see certain trends, there are still these pockets, there's still these areas that you really should be thinking about in terms of the risk profile of your portfolio. Demographically, if we dig a little bit deeper in terms of where those pockets of stress are coming from, we are unfortunately still seeing younger consumers under the age of 36 being impacted the most. So if we look at what we call the 90+ delinquency level, so this is where they've missed a payment for 90 days or more, on that group, those levels were up around 19.7% year on year. and actually still up compared to last quarter by over 1%. So for those younger consumers, there's still new financial stress coming in. Now, we do know that unemployment levels in particular have been rising for younger consumers the last few quarters. And so that likely is having an impact on that credit performance, as well as just general higher cost of living. Typically what we've seen in the past is that younger consumers, maybe they're not as well equipped to kind of weather periods of higher cost of living. They've got less savings as a bit of a buffer. So we are still seeing, unfortunately, them demonstrating a little bit more stress coming through. When we look provincially in terms of missed payments, Ontario is still standing out with high growth in delinquency levels. Now, we're still feeling some of the impact of interest rates on the population here in Ontario in particular. So I think we talked last time, if you joined us last time, we continue to talk about missed payments on mortgage holders in Ontario, both on their mortgage, but also the non-mortgage debt that they're carrying, as that, these mortgages are coming off super low rates that we saw during the pandemic, and they're renewing at higher levels of monthly payments. That is still having an impact on the ability for them to keep making payments on all of their credit commitments. And so that's one of the reasons why we're still kind of seeing those levels in Ontario rising. When we look at Alberta as well, we are seeing an uptick in missed payments there. Now, I mentioned earlier about this interprovincial migration that we've been seeing. Now, we did a bit of analysis to look at, okay, so what's happening with consumers entering Alberta and their missed payment levels compared to other consumers moving provincially across the country. And actually the missed payment levels for those entering Alberta are 26% higher than those we see move elsewhere. So one of the reasons behind that, we do believe potentially as consumers are leaving these kind of higher cost of living areas like Ontario, like BC, and they're moving to Alberta, they maybe are already more financially stressed. And so they're kind of taking some of that financial stress with them. Also in Alberta, of course, as you know, there has been a lot of population growth. It takes time for the employment levels and business investment to catch up a little bit on that. So that's probably one of the reasons, again, why we are seeing a little bit of increase in Alberta as well. So what does all this mean in terms of new credit demand? Well, we're actually seeing a bit of a slowdown in terms of new credit opening. And we think that's probably coming from a few areas. So first of all, demand in general, we think is slowing across certain areas. Consumers may be delaying seeking new credit. So for example, first-time home buyers on mortgages. And they're picking up a little bit, but still not back to some of the levels that we saw previously. So some of that demand might just be lacking from a consumer side. But the other thing we're seeing, which is kind of that left-hand chart there, we're seeing an increase in the ratio between number of inquiries and subsequent open trades. So this is how many inquiries that we see before trade is opened. Now that ratio is rising more for lower scoring consumers. Now that suggests that lenders actually could be starting to tighten their adjudication strategies a little bit. So there's more inquiries needed to get an approval on some credit for those lower scoring consumers. Now the ratio, when we look at higher scoring consumers, so those that are a bit low risk, that is up as well, but certainly by not the same amount. And that's kind of why we think there definitely is some tightening that's happening on those lower scoring individuals. On the higher scoring end, some of that may just be increased shopping behavior because we know interest rates are higher, although they have come down a little bit. We think there probably is some shopping behavior that's happening there. And then finally, just take a super high level look at insolvencies. Yes, we've kind of had those higher delinquency levels in past quarters. Overall insolvency levels, though, have been relatively stable. And actually, we've seen a bit of a drop in volumes year on year. So there's a little bit of good news when we look at insolvency levels. One thing that is worth noting, though, is that insolvencies, where those insolvencies actually are happening, the exposure to lenders is rising. So the average debt level on the insolvencies is actually around 9.5% higher than it was 12 months ago. So slightly lower volumes, but the dollar amount is going up of those. And that's particularly noticeable when we look at Ontario and BC, where again, there's higher debt levels, higher mortgage levels, things like that impacting them. Okay, so that's super high level what's happening with the Canadian economy, some of the pockets of stress that we're thinking about at a consumer level. But Kathy, maybe you can help summarize up what this means for lenders and maybe what we all should be thinking about.
Great, thanks, Becky. So we've got quite a few factors such as GDP slowing down, the unemployment rate rising, we've got inflation on food and rent going up, and of course we've got that trade deficit happening as well. All of this is really creating that macroeconomic headwind that's directly impacting Canadians. And that's exactly what the data is saying and what we're seeing. So as we heard, we've got a clear divide between the mortgage holders and the non-mortgage holders in terms of their financial health, where those with the mortgage seem to be managing their debt levels better and making payments on time compared to those without a mortgage, where debt levels are really mounting and that comparative delinquency rate has doubled. The other segment of the population that we heard that's really continuing to experience stress is that younger consumer who is under 36. You know, this segment really stands out in terms of having the highest delinquency rate, which is tied back to a challenging labor market and lower wages. So on one hand, right, if there's no job with no income coming in, it's pretty hard to make your obligations, your debt obligations. And on the other hand, if the salary is not high to begin with, or it's not increasing at the same rate of inflation for things like food and shelter, then you've got a shortfall there as well. So kind of like a double-edged sword there for the younger consumer. We heard about regional differences, right? Another area that's driving variation when it comes to a consumer's financial health, given that different places in Canada have different costs of living and affordability levels. You know, this is why, as we heard from Becky, we're seeing a lot more sort of migration patterns, like the interprovincial movement, where people are relocating from places like BC and Ontario to more affordable places like Alberta. And lastly, just in general, the turbulence in the economy. We've seen a lot of caution both on the consumer side and on the lender side, with less new credit applications going through. So if you've joined us before, you know that I like to ask a question, which is, you know, what does this all mean? And if you're a lender, what should you be thinking about? So for starters, you know, there's quite a few segments that we've sort of called out in terms of like the mortgage holder and the non-mortgage holder, where if your adjudication scorecards or your account management models don't already include segmentation, there's definitely an opportunity to make adjustments and optimize them. It is a best practice to really monitor the performance of your risk models, optimize them, given that the economic environment is really impacting the consumer's financial health and behavior. So one of the key things that is important for a lender to be doing is, you know, looking at new data attributes, looking at scores, like trended attributes, cash flow indicators, pre-delinquency scores, bankruptcy scores. You know, all of this can add lift to your models and really help with optimizing your business's growth potential while mitigating for risk. So before Swarnima actually moves us into the mortgage section, I'm going to pause, and I think we're going to turn to some questions that have come in.
Yep, sure, absolutely. So there was a question, do we know the reasons behind why Gen Z and late millennials are seeing an increase in late payments? So I would say, you know, one of the reasons we know is, I think I touched on, is linked to some of the macro conditions. We know that unemployment level have been rising for some of those younger consumers. And again, just some of the ability to kind of keep up with some of those payments, given cost of living is so much higher. There's a question, is the level of debt on slide 11 rising in line with the increasing cost of the various good categories? So houses, cars, etc. Great question. So yeah, inflation certainly will be playing a role in terms of some of those overall debt levels. We don't back out inflation from that number. We do have coming up later on, though, a little bit of a view in terms of spend and things like that, where we do back out the inflation. So we'll kind of hold off for now, and we'll touch on that one a little bit later. So Kathy, maybe back to you. Or Swarnima. Is it Swarnima next?
Yes. Okay,
Sorry,
so
Swarnima.
let's start with the big picture. Mortgage growth is still sluggish, even though originations rose 15%. Sales are still lower, and overall recovery hasn't really materialized yet. And what we are seeing is a standoff between buyers waiting for better affordability and lenders dealing with cautious demand. missed payments are up, but there's more beneath the surface. We need to understand who is struggling and why. The real drivers are, again, affordability, consumer behavior, and those vary sharply by segments and by region. And to unpack this, let's begin with first-time home buyers because they often set the tone for the overall demand. Despite modest rate cuts and slightly lower house prices, first-time buyers are not coming back in large numbers. They're probably waiting and hoping conditions would improve further. While their share of originations continue to fall, there was a small bump in year-over-year growth, but only in select provinces. So when you look at Ontario and BC, the once red-hot markets during 2021 and 2022 have cooled down dramatically. Prices peaked, affordability fell, and new buyers pulled back. And then Alberta briefly became the bright spot, attracting interprovincial migrants and more first-time home buyers. But even there, the momentum has slightly dipped. So the uneven geography tells us affordability challenges are structural, they're not temporary. Average loan amounts have been climbing up, and the gap between the house prices and the loan amounts is wider than ever, especially in Ontario and BC, where loans are nearly 20% higher above the national average. So in short, new buyers are cautious, regional differences are widening, and that leaves renewals, not new sales, which is actually driving the mortgage market. Renewals are the main drivers of the mortgage market right now. We are seeing over 1 million Canadians face renewals each year. Unlike past, when renewals often lowered payments or kept the payments same, today most bring payment shocks. In 2019, only 10% of renewals or refinances saw payment increase by more than $300. So, but in 2024, that has tripled. So borrowers are renewing into much higher rates than original loans, especially those that originated in 2020 and 2021, who logged in lower rates. The impact, again, isn't spread evenly. Fixed rate borrowers from 2020 face the sharpest jump, while variable borrowers have already absorbed some of the pain along the way. Now, to understand the level of payment shock, if you look at the chart on the right side, the gray bar shows the fixed 5-year term interest rate for mortgages open in July each year. And the red stacked bar shows what their rate would look like at the time of renewal, assuming they renew again in a 5-year fixed term. We can clearly see that the mortgages from 2017 and 2019 faced higher interest rates at renewal. However, we do not see financial stress coming from these mortgages, as many took advantage of the lower rates back during the pandemic in 2020 and 2021 and refinanced. Hence, majority of payment shock will end up coming from mortgages that originated either in 2020 or renewed or refinanced in 2020 and are again ready to be renewed in 2025, where interest rates are over 200 basis points. If rates remain at the same level, we could see borrowers struggling in 2026 as well with payment increases. 2027 onwards, we could see borrowers get payment breaks and if the rates lower down. So this has already also translated into rise in delinquency across mortgage borrowers. And again, the stress is highly concentrated by region and mortgage type. Nationally, delinquencies are up, but the story is again not uniform. As we have been saying in the past few webinars, Ontario and British Columbia are the clear outliers. They have historic high missed payments in mortgages right now. They are well above pre-pandemic. Other provinces, which are actually showing much healthier credit performance, many are leveling off or even improving in 2025, proving that not all borrowers are equally stressed. This isn't a nationwide crisis. It's very concentrated, especially in certain provinces where housing ran the hottest during the pandemic. But even within these provinces, not every borrower looks the same. Let's zoom in further and see which type of loans are at the most risk. Okay, when We break delinquencies down by mortgage value as well as vintages. The pattern becomes clearer. High value mortgages are the main culprit, especially in Ontario and British Columbia. Remember, average loan amount there are 20% higher than national average, and that gap translates into bigger payment burdens and higher missed payments. The chart on the right, it's a busy chart, it shows a striking reversal in delinquency trend across the provinces. Loans before the pandemic in Ontario and BC had lower delinquency rates than the national averages, but loans originating after 2020 show the opposite trends for Ontario and BC, with sharper rise in delinquencies than overall delinquency rates. So higher loan values plus high rates equal higher financial stress, and it's playing out most in the provinces that stretched the furthest during the pandemic time. So while Canada overall looks steady, the real risk is concentrated in those pandemic era high value mortgages. So with that, I'll hand over to Kathy to talk through what all this means for lenders and the broader market outlook. Kathy?
Great, thanks, Swarnima. So actually, before I jump into that, I just want to really sum up for everybody in terms of what we heard with regards to the mortgage industry. So even though we've had, a few interest rate drops and the average price point of homes have come down, we haven't really seen much activity from first-time home buyers stepping off the sidelines trying to get into the market. And the lack of sales activity in general in Ontario and BC has really impacted the overall sales numbers for this industry. Where we are seeing the majority of the activity, though, is through renewals. We heard that those that essentially bought early on in the pandemic. However, this cohort is also facing payment shocks, given that they have to renew at a higher interest rate, which means overall this may add some financial strain and cut into any available cash flow that they may or may not have. And in provinces like Ontario and BC, that we've been hearing about, where the amount of the payment shock is significantly more than in other regions, this is contributing to that stress that's coming through as a form of delinquency and hitting the historical highs that we're seeing. So again, what does this all mean? And if you are a lender, what should you be thinking about, or what should you be doing? So for starters, I'm going to just tackle renewals. A customer, just know a customer is going to be looking for the best rate to limit their payment shock, and that is going to include shopping around, right? So this is where, as a lender, you can play offense. Get ahead, understand if there is any attrition risk within your portfolio. Use a predictive model, like perhaps our mortgage attrition predictor, to score and rank order who to target, who to engage with, so that you can get that renewal win. Lenders can also create some stickiness here by offering access to credit health tools to really support the consumer on their journey to good financial health. For regional hotspots like Ontario and BC, right, it's going to be really, really important to ensure that all of your risk models look at these consumers in these regions differently at renewal time. You have to take into account, you heard Swarnima, higher value loans and the higher cost of living, along with cash flow and any debt obligations that they have. This is where, again, newer trending scores or attributes should be incorporated that look at, payment trends. What's happened in the past 3 months, 6 months, 12 months, to understand the trajectory of that, of sort of those payment levels, so that you can gauge how much stress would a payment shock create at renewal time. And so for the accounts that are on the books, so not those that are going through renewal, but they're on the books, equally important, right? Monitor these as well. Customers living in the hot zones are also at risk of getting into trouble with delinquency. So again, great opportunity. Use monitoring solutions like triggers programs, where you get notified if something starts to look off and you can lean in and help. Or upping really the frequency of your portfolio refreshes to get the latest credit data, because we all know that a consumer's financial position can change very, very quickly. Last thing I just want to touch on is those first-time home buyers, right? Economic uncertainty has probably given them a little bit of sort of hesitation in terms of entering the market, but there's definitely pent-up demand here. So this is where there's a great opportunity for your product teams to actually open the door with product solutions that's going to encourage them to come off the sidelines and make you a top choice for their mortgage needs. So On that note, I think it's time to balance things out and tap right into credit cards.
Amazing. Thank you, Kathy. I do love your puns, by the way. I'm liking the ones today. Okay, so let's start with some of the key trends that we're seeing on the credit card side of things before deep diving into a few areas. So at an overall level, we are seeing the consumer debt on credit cards rising. It's up around 3% compared to last quarter and almost 6% year on year. Now, some of that, I think, as we kind of touched on in some of the questions earlier, there will be a little bit of inflation-related impact that goes on with credit card balances. If things cost more, just there's more balance to put on your credit card. But we normally would actually expect that second quarter seasonally to see a bit more of an increase. So it's up, but not as much as we would expect. So perhaps there is a little bit of pullback in terms of credit card usage. The slowdown in population growth I mentioned earlier, that's probably continuing to hamper those new card growth elements, which are still down around 4.5% compared to 12 months ago. But we did see a bit of a pickup in the last quarter. So a little bit of good news. Maybe there's a little bit of renewed activity in that credit card market. Delinquency levels wise, they are still up compared to 12 months ago. But if you look at those two bottom rows that we have on the slide there, that's the dollar and volume 90-day or more missed payment rate. You can see when we start to look at the quarter on quarter movements, actually it is starting to slow down. So again, back to kind of what I was saying at the beginning around those delinquency levels are starting to stabilize a little bit. You can see it here with just that overall delinquency rates from a volume standpoint on cards being down 0.7% quarter on quarter. So if we take a bit more of a deeper look into what's happening on the card origination side, so this is kind of when we're looking at new card growth, it did pick up a little bit compared to last quarter, but we are still running at levels that are way down compared to 12 months ago. Now, that's probably linked, again, back to kind of the reduced numbers in terms of immigration, new to Canada. There was an awful lot of growth we saw in the last couple of years on credit cards from that population. But it's also probably linked to, again, some of those tightening of lending strategies by some of the providers. If we look at kind of that left-hand chart where we're breaking down where we're seeing growth in new or lack of growth in new card originations coming from different score ranges, we're really only seeing growth more in the kind of higher score ranges. So again, perhaps suggesting a bit more of a slowdown or a bit more of a tightening for some of those higher risk individuals. You can also kind of see that a little bit when we start to look at what's happening in terms of the balance distribution. So when we look at balance overall, kind of what's happening in terms of where that's sitting across different groups of card users. You can see that new to credit population on the right-hand side, bottom left. The balances of those are down around 8.6% compared to 12 months ago. And where we're really seeing the highest growth is in delinquent balance, up 15.3%, and also on revolvers. So revolvers, of course, are consumers that don't pay their credit card balance in full, their revolver balance to next month. That's up around 5.4%. So I mentioned earlier that we would touch a little bit in terms of spend and usage and kind of what happens when you back out some of the inflation levels. So last quarter, we definitely saw a slowdown in terms of spend on credit cards, again, after adjusting for inflation levels. That has stabilized a little bit, but we're still seeing spend on credit cards at or below 2024 levels. Now, we talked earlier about that widening of financial gap between certain consumer groups, and we see this on card spend as well. So consumers that have a mortgage, they've actually reduced some of their credit card spending in the last 12 months, perhaps pulling back a little bit on some of those big ticket discretionary purchases. Whereas the non-mortgage consumers, we actually saw a bit of an increase in spend. Now, one thing to call out from a risk standpoint, and if you're looking at your portfolio, is we often look at pay rates on cards, kind of spend to payment ratios and how they are changing over time, because they can be a really good early indicator of financial stress or actually improving conditions. Now, we actually saw a bit of a decline in terms of payment to spend ratios and kind of the pay rates in Q2. So consumers paying back an average of 97 cents per every dollar that they spend. So a little bit of slowdown, again, suggesting there are still some pockets of stress coming through there. We also mentioned earlier, again, back on younger consumers, and we talked about some of the signs of increasing financial stress. This is really evident when we look at the credit card side of things. Now, often younger consumers, they're much more likely to have credit cards in general than perhaps some of the other types of lending products. But, you know, we are seeing a bit of a difference when we kind of compare younger to older consumers. So if you look at that left-hand chart, this is delinquency levels or missed payment levels over varying years by age ranges. And you can see there that it's much more evident in terms of the increase in that red bar for those younger consumers. Those missed payment rates are rising much faster than we've seen before. The right-hand chart is actually a bit of a different view and kind of an interesting one to look at. This is where we're looking at when someone opens a new credit card, what is their kind of behavior? How are they spending and increasing balances in the first 3 months from opening their card? So those blue bars, that is back in 2019, split by different age ranges, what the balance was 3 months later. The orange is then what happened in 2024. So we saw those balances rising at a quicker rate. The gray is what we're seeing this year. So actually, when we look at older consumers, those 46 or over in terms of age ranges, actually we're starting to see when they open a new card, the balances are actually lower than they were 12 months ago. So comparably, they're actually spending less, or maybe they're paying back a little bit more and keeping those balances a little bit lower. Whereas younger consumers, they're actually still increasing the balance on the credit card. So there's still more reliance in terms of on the credit card side of things. And then finally, just looking a little bit in terms of what's happening provincially for credit cards. You know, again, we mentioned Ontario, BC, and Alberta earlier. You can definitely see the increases in terms of missed payments for those provinces as well. So you see on Ontario there and BC at the top on the left-hand side, up kind of 39% and up 26% year on year in terms of missed payments. That right-hand chart just breaks down a little bit in terms of vintages. So these are newly opened cards by year. What's kind of happening with some of the behaviors there? And we are unfortunately seeing new cards open in 2024. They are starting to miss some payments a little bit quicker than perhaps some of the other years that have come through. So, you know, again, there is some stress still there. Certain geography, certain age ranges, really important to be looking at. You know, if you have a credit card portfolio, how this is playing out in your book. And Kathy, maybe back to you. You can give us a few insights in terms of what might lenders be thinking about there.
Great, thanks, Becky. So yes, charging right in there. We've got a card market that has actually softened. We've got more revolvers, as we heard, contributing to balances rolling forward, an evident pullback on discretionary spending by consumers, and of course, a delinquency rate that keeps increasing due to the younger population, which is unfortunately a cohort that seems to be starting off their credit journey carrying a lot of debt, and in many cases are struggling to keep up and even making a minimum payment. Hence why we're seeing the defaults and the missed payments. And if you recall what I said at the beginning, in terms of sort of the stress on that younger consumer, that correlates back to, you know, a challenging labor market and lower salary jobs, which are essentially contributing to this. So in terms of, you know, the regional differences, we've seen a similar pattern here in terms of Ontario and BC, and the same goes with cardholders in these provinces, and even Alberta, really driving that charge in terms of missed payments because of the impact of the economic uncertainty. And for new cardholders in these areas, right, the stress of their environment is really contributing to why we're seeing higher delinquency rates, especially for newer vintages here, as we heard Becky talk about it through the charts. So once again, wrapping this all up together, you know, what should a lender in this space be thinking about, or what should they be doing? So for starters, again, we're in a low growth market environment, which means, you know, shifting the focus to looking at growing from within. And what I mean by this is looking at understanding the quality of your portfolio. You know, who are your best customers? Are you engaged with them through a campaign activity for CLIs? You know, is there another segment in your book that you can target to increase card usage so that, you know, you're the top card in their wallet? All of this really can be accomplished by using updated credit information, including the office view. Again, the view that you don't know, but what's the competitive view, to really drive both marketing and retention campaigns along with the right treatment strategy. Using frequent and refreshed bureau data really keeps you on top of understanding the overall financial health of these customers by leveraging key attributes that are generated from a credit report. And really the same approach applies to any new card demand that's coming through the door, right? Ensure you're assessing risk optimally. And once those customers are in your books, you're driving engagement campaigns and retention strategies for their growing credit journey with you. Last thing, really important is, you don't want to have a collections and recovery backlog, especially with the delinquency trends on the rise. You really need to focus in on loss prevention. So this is where use your analytics team, identify at-risk customers, or use innovative solutions like our pre-delinquency score or surprise bankruptcy score to really just help you proactively carve out those at-risk segments that then you can reach out to and offer support programs, payment plans to avoid defaults. So on that note, I'm going to let Swarnima jump back into the driver's seat and steer us into some auto talk. Swarnima.
Thanks, Kathy. Okay, so the auto market looked strong through 2024. Demand recovered, vehicles were more available, originations rose. But heading into 2025, the momentum is slowing. Rising caution from both lenders and consumers is starting to show effect. And just like mortgages, the story isn't just growth. It's about who can access credit and who can keep up with payments. Let's start by looking at how lenders are approaching new applications. So Q2 and Q3, the second and third quarter of the year are usually seasonal peaks for auto originations, but in 2025, volumes didn't rise as expected. Growth was now concentrated in prime and high score borrowers. Subprime growth is slowing, showing lenders are being selective. Unlike 2024, where new originations was up across the board, we are not seeing that anymore in 2025. Applications are getting more scrutiny, sometimes 2 or 3 rejections before eventual approval, especially for used cars. So looks here means the number of times an application gets rejected before getting approved. And approval rates for new cars have remained stable, but it's the used car loans that are under tighter review. Nearly 23% of used car applications faced multiple rejections before getting approved in 2025, which is double the 2019 rate. So lenders are clearly managing risk upfront, which may keep delinquency in check, but it also means tighter access for riskier borrowers. And part of why lenders and consumers are cautious comes down again to affordability. So let's look at the prices. Vehicle affordability remains a big barrier. Prices are dipping in 2024 and dipped in 2024 and climbed back again in 2025. So average loan amounts, if you look at it in 2025, is now over $9,000 when compared to pre-pandemic. And monthly payments on these loans are over $150 to $200 more, whether it's new car or used car. And used car particularly strained again. Supply is getting tight because fewer leases and sales happened during the pandemic, leaving a gap in the 2 to 4 year old inventory, which is a more popular option for used cars. New cars also, we're seeing prices starting to rise back again, and that has more to do with the trade sensitivity, production costs being passed on to the consumers. Even with slightly lower interest rates now providing some relief, auto loans are harder to afford and harder to service than just a few years ago. And the affordability strain is showing up very clearly in our delinquency trends. Auto was one of the first credit products where we saw delinquencies past pre-pandemic levels. The good news, the rate of increase has slowed in 2025 thanks to the tighter lending criteria, easing inflation and lower rates. The bad news, levels remain much higher than they were a year ago. And just like in credit cards, it's the younger consumers under 25 who are facing the most financial stress. They show the highest delinquency rates. as well as the steepest year-over-year increase in delinquencies. So very similar to what we saw in credit cards. And older consumers are faring better, managing their payments more effectively. Autos are a warning sign. Delinquencies may not be accelerating anymore, but they are still elevated. And the burden is falling on a lot of younger borrowers and new borrowers. Let's go one level deeper to see which vintages are struggling the most. Overall, auto delinquencies looks like they're stabilizing because we saw a drop quarter over quarter, but vintages tell a different story. For new cars, loans that are originating from 2024 show a much steeper delinquency curve than prior vintages. So many of these were issued during the rebound across all credit tiers that we saw in the previous slides. But for used car, vintages from 2020 onwards, so auto loans that originated in 2020 and after 2020 are struggling the most. So borrower took large loan amounts when prices peaked, rates were rising, and they have been missing payments at a much higher rate ever since. And these vintages point to real affordability cracks that could persist if economic headwinds worsen. So while the overall market shows signs of stabilizing, the underlying strain in certain vintages mean auto credit could stay volatile. With that, I'll hand it to Kathy to talk more about how should lenders be positioning themselves in this environment. Kathy.
Great. Thanks, Swarnima. Okay, folks, final lap. So we've clearly seen a lot more caution from the lender side, given the turbulence of the economy resulting in those fewer loan approvals last quarter. And even though the volume of applications was pretty high, especially true for used vehicle applications that went through more scrutiny, and also even more evident in pre-approval channels that yielded a higher number of declines there as well. So the other thing that we've been seeing is, from a price perspective, the spike in demand for used vehicles and the constraint on the supply side really drove prices up. So basic economics 101 there. And a similar price pattern is also expected to follow for new vehicles in the second half of this year. And of course, with the economic uncertainty that's continuing and the trade-related discussions that are in flight, we do expect continued volatility in this market. Loans that have originated in recent vintages, as we just heard from Swarnima, they continue to show signs of higher risk with the likeliness of defaulting. And coming back to that younger population segment, I feel like we've been picking on them this hour, but they continue to be that high-risk cohort for auto loans as well that are behind the rising delinquency rate here. So once again, taking all this into perspective, if you're a lender in this space, what should you be thinking about, or what should you be doing? So first thing, loss prevention. It's going to be key, which means really looking closely to understand, who on your books faces an increased risk of defaulting. So take a look at the loans that originated in the last few years. Look at the age splits, look at regional splits, bring in current credit scores and attributes to sort of, characterize the segments. Look at analyzing the segments differently. Again, another opportunity to leverage innovative scores and solutions that we have to offer to sort of, add that lift to your models. The goal is really to just identify and prioritize who you need to monitor, so that you can sort of hone in more closely so that you can then proactively take action. And lastly, something that we haven't touched on, but I think it's really important for the auto sector, is first-party fraud, right? It's been a challenge in the auto space. And again, it relates back to affordability and cost of living. As both of those elements continue to increase, really it's important to have the right screening tools in place to identify such applications so that you can decline them. The last thing you want to do is approve applications that have clearly misrepresented information, and that consumer, does not actually have the ability to take on a loan given their financial position. So on that note, that does bring us to the finish line, or at least my finish line. So I'm going to hand it back to Becky to take us through some Q&A.
Thank you so much, Kathy. Okay, so we've got a lot of questions coming in. I know we're getting short on time, so we'll try and do a couple of these. For credit cards, are clients focused on paying down the balance or more people making the minimum payments? Great question. So we do see kind of a fair amount of transactors which are paying in full in the credit card portfolio, but we certainly have seen in the last few quarters the number of minimum payers is rising, and we've seen that again a little bit more for younger consumers as well. So hopefully that answers that one. Do we have the 90+ delinquency rates available for different provinces? We will follow up with you afterwards and try and send those out to you. Let me see what else we've got in here. What are those without a mortgage getting behind on? Credit cards or other types of products? So if we go back to kind of the beginning, credit cards typically does have the kind of highest missed payment level. That's just because when we look at what we call the payment hierarchy, they tend to miss payments on credit cards first. That's whether you have a mortgage or a non-mortgage. But we've certainly seen increases as well in terms of auto loans and unsecured lines of credit in particular. But credit cards, typically that is the first product which you see missed payments on. That's why we always highly encourage you to monitor things like payment behaviors on credit cards and things like that, because it can be a good early warning sign. In your slides, we do see lenders are more selective in 2025 for credit card auto loans. Do you have any info on the mortgage side? Same story. So I don't know if we actually have any numbers to hand on that, but we can take a look and maybe follow up next time on that one. So apologies if we didn't get to your questions. I know there's a lot in there. We will absolutely try and follow up with you after the session. While we've got 2 minutes left, I do want to kind of just talk to you about 2 upcoming events that it's definitely worthwhile attending if you can. So the first one Jordan mentioned earlier, which is our Q2 2025 Business Credit Trends on September 18th. We have Sinead and Jeff from the Equifax side, and we have Carmen joining us as a guest speaker. There's an awful lot going on the business side right now. Really, really important to kind of look at that as well, even if you focus more on the consumer side of your portfolio, because obviously unemployment is a very important factor. And so if businesses aren't investing or there are job losses, that's also good to know about. Second thing is Equifax are sponsors of the Credit Scoring and Risk Strategy Association Conference, which is on October 9th in Toronto. So there's a one-day event. I myself am not presenting. I'm on the slide, but I actually won't be presenting, but I do sit on the board of directors of the CSRSA. So there is an amazing agenda for that day. From Equifax side, we have our global Chief AI Officer, Raghu, coming over from Atlanta to join us for that. And he's going to be talking about artificial intelligence and how that is really helping to empower credit risk strategies. And then we have Jeff Brown from our commercial team joining us with Corrine from BDC, so the Business Development Canada, talking a little bit around small business risks. There is also an amazing risk officer panel. So we have, I think, 4 of the big 5 banks, their executives coming to join us to do a risk panel. It's going to be an amazing event. So if you are interested in joining that, there is a coupon code that you can see there for 20% off. Again, great agenda for the CSRSA event in Toronto as well. And I think Jordan mentioned, I don't have a slide for it, but again, our upcoming fraud webinar as well. Definitely worthwhile keeping up to date with what's happening in the fraud side of things. So that's all I have for you for today. Thank you again for joining us on behalf of myself, Kathy, Swanima, and the team here. And hopefully we will see you next time for our Q3 trends. Thanks so much.